All right. Hey, trust you are doing well and had a great week this week. Want to share with you some of the things that our team and what we're looking at here this month. The question that really I want to ask you is, who is Josh Frost? Do you know that name? Everybody knows, hey, Warren Buffett. Josh Frost is an important name, though. He's the Assistant Secretary for Financial Markets at the Treasury Department. So he's the one that actually sets the mix of treasuries that are going to be auctioned off to fund the massive government deficits that the, political leaders continue to just plow into. And I shared a previous video that this is going to be something that more and more you and I need to pay attention to over the years ahead. Right now, so beginning back in, I think, around March of 22, the Fed, in conjunction with the plan to raise interest rates, also started a process of reducing their balance sheet. It's called quantitative tightening. What that is they have about $60 billion worth of treasuries that are maturing each month, and they would renew those. And the balance on the deficit at the balance sheet at the Treasury, was about $9 trillion. So what they've done is they allow those to mature and don't replace them, meaning they don't buy new, and so it reduces the size of the balance sheet. So that's down to about $7.7 million. And so, by doing that, it puts more demand in the system that more bonds have to be bought by not the government, meaning the Federal Reserve, for their balance sheet. So in the most recent mix on Wednesday, they auctioned off $42 billion worth of treasuries, just about an average yield above 4.09%, which was actually lower than the anticipated rate. So that's a good sign there. But what also Josh does is he takes and looks at what the market demand is, what interest rates are, and then they make a decision, maybe not him just alone, but his team as well, and then deciding what is the mixture of bonds that are going to be offered, meaning 2-year, 10-year, 30-year, that type of thing. And so the market, well received that offering and bought those bonds up. The previous auction I shared about with you was where they had to kind of manipulate things around and load more into the 2-year versus the 10-year at the previous auction. And this is something that's going to be more important. And the reason it's going to be more important is because, last year our U.S. debt was downgraded. And, over time, there's going to be a continuation of questioning, can the U.S. support such unreasonable levels of deficit spending? I mean, yes, we have the biggest economy. Yes, we have been the historical powerhouse of the world. Yes, we have been the superpower economic engine in the world. But that being said, China doesn't have a strong interest in purchasing our debt. Japan is now in a territory where they are at least in positive interest rate zone, where they've been in negative interest rates for quite some time. So they're more also beneficially focused on their own country. And so this is a concern. And so I say that because the more pressure that is, and again, just thinking about it from this perspective, when you have more people buying treasuries, there's more demand. So if you have more demand for the bond, the price of the bond goes up, and then the yield, meaning the interest rate, goes down. And so it's a good thing when people are demanding to buy treasuries. We spoke about before, the economy's been very strong, surprisingly strong, stronger than most anticipated, especially the jobs market. As we get into a softening of that, then more people rotate their money over to bonds, because as you enter into a recessionary time or a declining economic time, there's more confidence in the stability of the bonds and more money moves into that. And you've got about $8.8 trillion in cash. We'll talk about that in another video. But again, there is going to be a number of those monies rotating in to the bond market as well. And that's already happened as well, and especially more as there's an anticipation that rates are starting to decline. And so, this is important for us to watch. It's important for you to be on top of, and it really does matter, because it helps to understand what the expectation is with the bond market, which is really what the driver is for long-term fixed interest rates. The Fed, when they make adjustments to their overnight rate, that's just the overnight rate that's available for banks on repurchase monies, and it sets the tone for SOFR, and then that in turn sets the stage for a lot of the variable rate loans, whether it's a bridge debt or credit cards or auto loans. And those things are important as well. And of course, we're watching that as well. So, hey, thank you so much for tuning in. Look forward to our discussions that we're having, and also look forward to you being a part of the Prosperity family. And for those of you that are, truly grateful for the trust and confidence that you've placed in us over the last 20 plus years. Have a blessed and victorious week, for this is the week God has ordained for you.